It's a delight. It's fantastic to be here, to actually interact with people again after 2 years. The only problem I had was the dress code, because I've not worn anything other than pajama pants for 2 years now. And I had real problems actually putting on my business shoes this morning because I'd forgotten how to fasten them. I think it's really interesting what's been going on in the crypto exchange space, in that it's really reached a new level of maturity. Some of us may have thought crypto was a passing fad, but it's moved on from just being Bitcoin. And it's converging a lot more with the vision of the future in terms of the whole digital asset space. Because, we as a firm believe, that digital assets have a really significant position in market microstructure going forwards, and that they're really going to change particularly the whole post-trade process. We're starting to see regulation emerge, and there's been really a lack of leadership in regulation in the crypto space. It's almost been like it's this hot potato. SEC have said it's not our bailiwick, CFTC have said it's not ours, other regulators around the world, but now we're seeing actually the emergence of some serious moves, particularly after Biden's presentation, towards proper, more formalized regulation of the market. And that, we believe, is only a good thing. And what we're seeing is that it's really driving dramatic change in the technologies that are being brought into play. The fact that we can move from something like T+2 to almost real-time settlement. The fact that we're seeing the emergence of these disintermediated marketplaces with direct participation. The fact that we're moving from at most a 5.5 by 24 market to a 7 by 24 market. The fact that there's the widespread adoption of cloud technologies for trading as well, whereas everybody had always thought that the gold standard was absolute colo with the lowest possible latency, and the involvement of the global market making firms. So, Jump stepping up to the plate and filling the $320 million gap from the wormhole hack with their own money. Citadel Securities. And Citadel, Ken Griffin, I think, had always said he wouldn't trade anything he couldn't value. But for Citadel Securities to move into the crypto space, but bringing in external backers as well, I think we're seeing a lot of rapid change. So, and now the ASX acquisition by SIBO, and now the FTX announcement as well, show the expansion into the real-world derivatives space as well. So, enormous change, massively beneficial for the industry, serious players coming to the market, and really a sea change happening in our industry. One thing that we've noticed is that secondary exchanges have struggled for liquidity over the last decade or more. And there have been various initiatives to try and aggregate liquidity. So we saw, the ASEAN platform, which struggled and failed. We saw MILA, the Mercado Integrale Latinoamericano, also trying to do the same in Latin America and struggling. And interestingly, one of the reasons they struggled was they only focused on trading. They didn't think about post-trade. And as we all know, post-trade is the really important stuff, because that's what assures the integrity of markets. For the last couple of years, the exchanges in Colombia, Peru, and Chile have been proposing to merge, and they've just now gone through their shareholder votes, and all of the shareholders in all three exchanges have voted to go ahead and integrate those three markets. We're seeing the two exchanges in Ecuador merging as well, and we're seeing an initiative to merge the exchanges in the Caribbean. And in particular, in this part of the world, one of the problems is that liquidity has kind of leached over into the US through ADRs or whatever, so that market makers have been able to access price formation out of the domestic markets, but have the liquidity emerge on the North American markets. And now we're seeing those other markets fight back. To try and pull back price formation and liquidity into those markets. But they know that in this day and age, you have to have the global market makers involved. You've got to have Citadel, you've got to have Virtu, you've got to have Jump and Flow and all of these other people. In order to attract these firms, you've got to have a value proposition, and that value proposition only comes about from having critical mass. So that's why we're starting to see these mergers happen, particularly in South America, across these three groupings, and who knows what will happen. Maybe it'll be one big group. I think everybody needs to sort of looks at B3 and wants to up their game to equal the success of B3. Who knows if that will spill over into Asia as well. We've continued to see Euronext grow through its own acquisitions of Ireland and Italy most recently. So we do believe that there's going to continue to be that level of consolidation within the exchange space. PFOF has been a uniquely US model. I mean, yes, it's been seen a little bit in Europe with firms like Trade Republic in Berlin, but it's been a uniquely US model. And I've seen both sides of the argument. One of the sides of the argument is, look, retail is getting the best price, the best execution. The other argument is that this flow isn't reaching the lit market, so it isn't participating in price formation. I think we've seen regulators in other parts of the world push back against payment for order flow and not view it as positive generally. Is it going to change in the US? It's hard to see how you can turn around something that involves so much of the order flow, particularly as we've seen retail order flows boom over the last 2 years with COVID. So are investors getting a bad deal because of PFOF? Probably not. Is it distorting markets? Possibly. I can't say how it's going to play out, but undoubtedly regulators in other parts of the world have not wanted that model to permeate into their markets. I'm very excited about the fact that SIBO has bought ChaiX Asia. They're now driving the growth of ChaiX Australia. From a very personal perspective, the ASX has had a very dominant monopoly for a long time, and it really needs competition. ChaiX has taken competition to the ASX to some extent, with about 20+% market share in equities and about 50% market share in warrants and ETFs. So it's really brought about a lot of change there. But again, what's prohibited ChaiX Australia and now SIBO Australia from growing further has been the ability to compete in post-trade. When I was running ChaiX Australia, we really wanted to push into the derivative space, and we really wanted to build a competing clearinghouse in conjunction with LCH. But the Reserve Bank prohibited a foreign clearinghouse clearing domestically significant products, being basically domestic equities and domestic short-term interest rate futures, which were the core products. So, we were frustrated in our ability to grow further by not being able to develop our own clearing platform. With SIBO now being involved, and with obviously their ownership of EuroCCP, I would hope that in the future we're going to see EuroCCP appear in Australia to clear potentially options to start with, but then potentially other products as well. And particularly with ASX's CHESS replacement project struggling, and who knows what's going to happen with that. Dominic Stevens, the CEO of ASX, has recently announced his retirement. No replacement has yet been announced, and obviously whoever replaces Dominic is going to drive that agenda. And whether that's to continue with the current proposal or to go down a different path, we don't know. But Australia needs stability in the knowledge of what is going to happen in the post-trade space. And I think that SIBO can play a significant role in that in the future. I would like to see them to anyway.
Okay.